Hey guys, it's Emil from Clockwork Money Team here with a quick video to present the basic informations and knowledge needed to start options trading on a regular basis. Hope you enjoy. Take care. As always, this is not financial advice. Do your own due diligence and you are 100% responsible of your financial decisions. So we'll start off with the basic terms. First off, what is a call option? A call option is basically a bet that a stock or the price of a stock will reach and cross a higher price than it is at the moment. When we call or being long, in other words, sorry for that. When we talk about puts, it's shorting the stock, betting that the stock is going to go downwards and cross a certain price and go under that price. That's when you buy a call and buy a put. Now you can sell calls, sell puts, and go with verticals, butterflies, there are a whole lot of strategies, but this video is mainly to explain the real basics of options trading and what you really need to know to get started. One of the main things about options trading is you're basically betting that the stock is going to go to a certain price. That is the strike price. So the strike price is the price you bet the stock is going to cross, whatever direction that might be. The volume of that stock is the number of contracts that were traded for that given day for that specific contract. The option open interest is the open interest. Basically, people that have limits, orders waiting to be sold or bought for this specific contract, or people that are open have a legitimate open interest in buying the contract if it comes to a certain price. Obviously, when you buy options, it's not like shares. You have a certain expiry, so a date expiry. So it's very important that before you buy or sell a put or a call, whatever price that might be, you always need to be sure and certain 100% of the date that the contracts expire. Because if your contracts concerning the bid and the ask, the bid is basically the price of the contract at which people that are currently owning contracts of this are willing, sorry, to sell at. The ask is the price that you would buy the contract at, so the price that buyers are willing to pay this contract. A term you might hear quite often or not with options is options Greek. These are basically divided in four different categories. There's delta, which basically expresses the correlation of the value of the options contract and the movement of the stock. So how does the value of the contract move in correlation to the movement of the stock? Theta is basically the time decay in correlation to the value of your contract. So theta is very important because that basically indicates to you how quickly the value of your contracts will climb or fall in correlation with time. When we're talking about gamma, gamma is directly correlated to delta. Delta basically expresses or indicates the value in correlation with the stock price, and gamma is basically what is used to measure such correlation. So gamma is basically how to figure out delta. And finally, there's the vega. Vega is basically the IV or the option implied volatility, sorry, of the contract. So this is basically the rate at which your contract will be, how can I say, will move in, but this time not only correlated with the stock, but the whole stock market as a whole. So if we're in a bear market, there's more volatility. The IV, the volatility of the contracts, will probably higher, whatever that might be for the stock price itself. It's more of a grand, bigger perspective about the volatility of the contracts according to a lot of under big, I don't want to say factors, but yeah, in the stock market. So before we wrap things up, I'd like to talk about one more thing, different options, strategies that you can have, or the terms related to the type of trades, not necessarily specifically or uniquely to options. It can be for regular day trading as well, but just basic terms that every trader, even more options traders, should know. First off, a day trade. A day trade is a trade that could be 5 seconds, like it could be for the whole day. Basically, it's a trade that you take and close the same day. A scalp is like a day trade, but way shorter. It's basically from 5 seconds to maybe a minute. It's very, very quick in and out. So just getting in and out quickly afterwards. Safer, less risk, but less reward as well. Concerning a swing is what we would call buying contract or stock and holding for a couple of days, couple of weeks, months, or in general, weeks, days, and months represent swing trading. And when we talk about leaps, that's usually buying contracts that are a bit further out of the money, whatever stock that might be, the strike price out of the money, obviously. And that expires in a couple of years, usually. So leaps. Sometimes when you're looking at option flow, you're going to hear different terms. A sweep is basically one big sweep of a lot of contracts for a stock. So it's basically one huge sweep. It usually takes a couple of, how could I say, minutes to process. And some other terms that you might hear when looking at option flow, specifically in the Discord or whatever option flow source or that you're using, the platform. Sorry. Um, a sweep is usually the biggest thing you want to see. A sweep is basically somebody buying a load of contracts, specifically the same contracts, but through one big sweep. So the order needs to be processed. It takes a bit more time to be processed and officialized. So people usually bet bigger amounts one way, and that's a good indicator of which direction a stock might be going. Another term is a block is how could I say, one block that usually represents a part of one sweep. So it's a smaller order. It can still be relatively big money wise, a couple hundred K, but usually sweeps are around a million, couple hundred K. Blocks tend to be between 10, maybe 100K. And lastly, but not least, split. A split is not a stock split itself, but a split order is usually small orders that get processed over time, whether that be an hour, 2 hours, or 15 minutes. Splits are basically small orders that come in one after the other. Yeah, talk about a stock split just because I mentioned it. Stock split is basically the way a company can decide to split their stock, like Amazon just did. By that, I mean dividing the shares small and smaller to a small the shares of the stock price, sorry, into smaller, more affordable shares. For example, Amazon going from 3,000 to 300, or Google going from 3,000 2,000, 3,000 to about a couple hundred. It's not only more affordable for the average investor, but it's also good for the companies because when they give stock incentives, well, they can give a bit more stock and it's more affordable for them and for the people. So when there's a stock split, uh, people get more shares, but they don't get more money. Their shares are the same value, they're just split in more shares, if that makes sense. A inverse stock split or a reverse stock split is basically when the stock goes from a smaller to a bigger stock price. Usually that's not very good. That means the want to track more volume to the stock or to the yeah. Thanks for watching, guys. I hope you enjoyed. If you want to join our group, our team, the Clockwork Money team, you can follow us at Clockwork Money Inc. on Instagram, TikTok, and YouTube. In which every single of those platforms in the description and bio, there will be the link to which you can subscribe to our membership. Looking forward to you joining the team. If you have any questions and commentaries, obviously DM or just simply write them in the commentaries and description. We always love to answer your questions. And yeah, good trading and take care, everybody.